I mean, China, and since then, of course, as you rightly say, no gold ever leaves the country.
No.
They've continued to accumulate gold from their mining operations, from their refining operations, bring in doré from other places like Mongolia and so on and so forth. And, the result is that they've probably got, I don't know, somewhere between 25 and 30,000 tons. And that's the state, on top of which there's a further sort of, 20 odd thousand tons in the hands of the public. This is a very, very big slice of above ground stocks. And so they are well protected against the time when Western fiat currencies actually, meet their Armageddon.
In a recent enlightening interview, Andrew Maguire and Alasdair Macleod delved into the intriguing dynamics of the East's burgeoning relationship with gold. One particularly captivating revelation was the robust savings culture in China, where the average citizen stashes away 40% of their income. What sets this practice apart is the Chinese government's proactive stance, allowing its populace to invest in gold to safeguard their wealth. Last June, the People's Bank of China quietly unfurled a noteworthy initiative that, surprisingly, went primarily underreported in the media. This transformative endeavor facilitates the seamless conversion of renminbi savings into tangible gold assets, typically in bank accounts. Alasdair points out that the Chinese government has long recognized the intrinsic value of gold as a bona fide form of currency. Illustrating this vision's tangible impact, the People's Bank of China emerged as the preeminent buyer in July, amassing 23 tons of gold to bolster its reserves. This marked the 9th consecutive month of accumulation for the Chinese central bank. Notably, China has assumed the mantle of the year's most voracious gold buyer, augmenting its official reserves by a staggering 188 tons. As of the latest update, the People's Bank of China proudly boasts an official gold hoard of 2,136 tons, constituting 4% of its overall reserves. Alasdair points out that this concerted effort signifies China's readiness for potential upheaval in Western currencies. Andrew complements this sentiment by highlighting the enduring allure of gold investments, where investors consistently perceive their gold holdings as a source of enduring value despite price fluctuations relative to the dollar. Before diving into Alasdair's interview with Andrew Maguire, subscribe to our channel and give this video a big thumbs up.
The average Chinese person saves something like, as you're saying in round numbers, 40%. But isn't it interesting that they were opened up to gold as a saving class?
Yeah.
And this is phenomenal to me because that is actually going to solve so many of the issues. When people, yes, the yuan may be up or down in price against the dollar, but the average person, what they see is my gold investment's going up. My gold investment's a very good investment. I think I'll have some more. And I think, again, you're dealing with a mindset there that goes back thousands of years, which is, well, always, I've gifted gold to weddings, to whatever the occasion, birthdays, gold is given. And it has a spiritual side to it too.
I can put this into, I think, some, sort of modern context, as it were.
Yeah.
I mean, as I understand it, I don't speak Mandarin, obviously, but I'm told that the word for money and gold is exactly the same. And independently of Roman law, which set out things that, gold is money and the rest is credit, and all us Westerners have it as the basis of our common law. It doesn't matter what our governments have said subsequently, that is fact. The Chinese already got there by, different routes, if you like. They realized that it is money. Now, after the death of Mao, in 1983, legislation was produced which appointed the People's Bank of China as the sole responsibility of acquiring and managing the state's gold reserves. Okay, so that was 1983. They started accumulating gold at a time when there was a massive bear market in gold, which took it down from, 1983, I think it was about $400-500, something like that, down to 250 or something in 2022. Coincidentally, in 2022, they'd obviously decided that they'd got enough gold. Now, I should also add that they increased their mine output, deliberately invested in mine output, so they became the largest miner in the world by a country mile. They also ensured they continued to have a monopoly over refining, and they were even importing gold from elsewhere, or doré or whatever, and refining it. And did it ever leave? Did it? Hell is like. No, it stayed there. So that was interesting. Now, they obviously decided that they'd acquired enough gold by 2022 to allow people to begin to acquire gold. And that was why the Shanghai Gold Exchange was set up, again, under the control of the People's Bank. It's 100% owned by the People's Bank. So since then, as you rightly pointed out, they've even had television adverts, buy gold, whatever. And, the Chinese people haven't needed a lot of persuading. It's come out of the vaults. What we look at is the Shanghai Gold Exchange deliveries out of the vaults. It's really come out into two markets. I mean, there's a bar market, and at the same time, you've obviously got the jewelry market. So there is a little bit of a dispute. And if you talk to the World Gold Council, they're really concentrating on the jewelry side. But since then, the people have accumulated, I think if you tot it up, something like 21,000 tons of gold on the basis of these deliveries. It is fascinating.
AlasdairMacleod's astute observations shed light on the looming specter of rising interest rates driven by the depreciation of major currencies. This potential scenario could trigger a credit crunch, a term recently gaining prominence due to concerns from the recent banking crisis. A credit crunch entails reducing credit availability, which can spell prolonged economic downturns or sluggish recoveries. This sobering prospect is now becoming ingrained in the market sentiment, as emphasized by Mike Novogratz, CEO of Galaxy Digital. The U.S. Federal Reserve has already responded by raising interest rates on 11 occasions since March 2022, aiming to combat inflation and restore it to its 2% target. New York Fed President John Williams believes we may be approaching the zenith of this rate-raising cycle. Notably, AlasdairMacleod underscores the situation's complexity for the U.S. government, as higher interest rates escalate the cost of managing their finances. Moreover, foreign nations holding substantial U.S. dollar assets could lose value should interest rates ascend further.
Chinese are already there. It's just they don't want to trigger it. The Russians are a lot more aggressive. But as far as the Chinese are concerned, no, we will let the West make mistakes. We will let Western currencies, sink. We will let all that happen. We are not going to aggravate this situation. It's not our style. We will defend ourselves from it when it is absolutely obvious that we've got no alternative but to defend ourselves from a sinking currency regime. And I think that's very important for us all to understand. And we are now in a position where that sinking currency regime is becoming very, very obvious. Interest rates are going to continue to rise. I mean, it's very, very interesting. I mean, people like Jim Grant, I'm told, I was interviewed by someone yesterday, and he had Jim Grant on, and he was saying that there seem to be more and more of these senior guys agreeing with me that interest rates are not going to go down. So the reason they go up basically is because currencies are weakening, and in terms of their purchasing power. So if you factor that in, and you factor in a credit crunch, which is the result of banks trying to reduce their balance sheets, and we've seen contraction in money supply in America, also the Eurozone in particular, UK as well. This is basically undermining the economy as a whole, but it's a credit crunch, and that's going to drive up interest rates. I mean, the idea that the Fed has got control over interest rates, forget it. This is a credit crunch. What happens when banks start restricting credit? Well, the first thing that happens is people need more credit. Why? Because their businesses are slowing down, and they need cash. So on that basis, this credit crunch has got quite some way to go. What does that do to government finances? Well, it puts America in a real pickle, because, not only are the foreigners, trying to get out of, or they will be trying to get out of US dollar financial assets, because with higher interest rates, guess what? Bond yields rise, which means bond prices fall. It also means that equities get undermined as well. And they've got $32 trillion worth of this stuff officially. Officially. On top of that, there's the Eurodollar market, and this is the subject of an article which will be published tomorrow. And it appears that the total size of dollars outside this market is around about 90 trillion. $90 trillion not in the banking system. And of that, 15 trillion is on non-US bank balance sheets. In other words, extra deposits. So the amount of dollars in a crisis that are going to try and get back home where they belong is absolutely phenomenal. And that, of course, will severely and very rapidly undermine the purchasing power, if you like, the faith and credit, put it that way, in that fiat currency.
As China's gold strategy and the looming specter of rising interest rates in the United States, how will these developments ultimately shape the global economic landscape, and what measures will governments and central banks take to navigate these challenges effectively? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Surprisingly, around 63% of our viewers have yet to subscribe. We aim to reach 3,000 subscribers in the next 2 weeks, and your support could make a big difference. Thank you for being a part of our community.